Howdy there, folks. Welcome into this buy one, get three free. 4 videos up here for me to react to. There's still gas in the tank in this stock market. Looking forward to hearing everybody's favorite bull, Tom Lee, speaks about what is coming for the market here, what's going to happen here, all those sorts of things. Might make a few shocking predictions in there. Then we're going to get an Ed Yardeni. This decade will turn out to be the roaring 2020s, okay? So let me just put it like this. We're going to go very, very bullish here at the beginning of this video. When you got Ed Yardeni and Tom Lee back to back, holy smokes, this ain't no dang jokers. Then we're going to get into this quick one about Tesla Robotaxi. I want to share my thoughts around that. And then the last one, maybe we'll get a little bearish because I feel like after that Tom Lee and Ed Yardeni, or Yardeni, I should say, I feel like we got to go a little bearish. And there is a little something to be bearish about here in these inflation numbers that we're going to speak about, okay? Make sure you're subscribed to the channel. If you are not subscribed to the channel, make sure you're subscribed, folks, so you can watch these videos, which I produce probably 4 or 5 days a week. And also, hidden comment down there, 6 days away. It's 6 days away, folks. The 1-day tax break, jailbreak sale for the Patreon tier that has access to my Become Master Stock Market course, my #1 course, has access to see the moves I'm making each week in that portfolio, and access to that Discord chat, all for $69. It's a 1-day sale. Pin comment down there, enter your info. 6 days away, folks. Okay, let's get into this.
He's seeing in the markets right now is Tom Lee. He is Fundstrat Global Advisors managing partner and a CNBC Tom. Contributor.
Cheers.
Tom, it's weird. We are sitting very near all-time highs, and yet it does feel like there is some nervousness in the market at this point. A lot of this is coming from hotter than expected inflation numbers, stronger than expected jobs reports, and manufacturing numbers, the ISM, that was better than anticipated too. That's got people wondering if the Fed is actually going to be able to cut rates this week. Are you unnerved by any of this?
I think this coming Wednesday, Becky, will really answer a lot of questions because I think you've summed it up well. Investors have been grappling with this idea that can the Fed be in a position to, reduce real rates if we've got good economic growth? Because what does that mean for inflation? And this coming Wednesday is March CPI. I think it's going to be the first clean CPI reported.
Bitcoin's back to 72,000. You're going to be flipping my flapjacks. By the way, I just got a text message. It's going to blow your mind. It's going to blow your mind, the text message I just received, okay? I just got to mention this because it's on my mind. I just received a text message from somebody, a realtor, that wants to book me to take photos and videos of some properties for them. I shut down that business in 2017. 2017. And believe it or not, even in 2024, I still have people reach out either via text or email trying to book me for jobs on a business I shut down. Like, oh my gosh, like what's next? Quick Trip's going to call me back and hey, can you come work a shift? I mean, my gosh, that's crazy. Like, that's really wild to me.
It won't have any residual seasonality. We're expecting that to be a pretty good report. Lower than expected inflation. And I think it's going to help investors get to this place where we can have pretty good growth in the economy. There's some slack in the labor markets, but inflation's falling fast enough for the Fed to actually cut rates this year. And of course, that'd be great for stocks.
I know you'd been telling people kind of buy on the dip. Not that there's been much of a dip if you're just talking about a pullback of a few percent. Does it matter if the Fed cuts rates or not? If the economy is really strong anyway, will earnings be able to justify the valuations at this point?
I think the Fed being supportive of the economy, so managing the business cycle, is the most important thing. In the last 2 years, the Fed was fighting inflation and therefore hawkish. That was tough for equities. But if we're in a mode where the Fed doesn't know how many cuts it needs to make, but it actually wants to support the business cycle, that's good for stocks. So I don't think you need to have 3 rate cuts. You could even have a good scenario where the Fed only cuts once. But if the Fed's in a position where they feel they need to actually raise interest rates, that'd be bad for stocks.
Hey, Tom, hold on just a moment. We've got some breaking news. We'd actually like to get your reaction, so if you don't mind listening in.
We just have some news literally crossing this moment, which is that Jamie Dimon's JP Morgan is publishing his annual letter to shareholders. And we want to bring you some of the news that's in this letter. a highly watched letter annually. Diamond writes the following. He says that despite the, quote, unsettling landscape, war in the Middle East and Ukraine, growing geopolitical tensions in China and polarized electorate here in the U.S., that the U.S. economy, he thinks, continues to be resilient with consumers still spending. He says the market seems to be pricing in a 70 to 80% chance of a soft landing, but Diamond thinks the odds are, quote, a lot lower. He cites persistent inflationary pressures, including what he says are, quote, ongoing fiscal spending, remilitarization of the world, restructuring of global trade and capital needs of the new green economy. Another major theme in the letter is artificial intelligence. Diamond writing that the consequences will be extraordinary. He says JP Morgan Chase has grown its AI organization, quote, materially with more than 2,000 machine learning experts or data scientists now on the payroll. Diamond also issuing a warning, quote, we may be entering one of the most treacherous geopolitical eras since World War II. He said he's also concerned about the large deficit.
Wait a minute. We might be entering. We already entered, sir, in all due respect.
Supported by quantitative easing. I will say on the World War II piece, he says, when terrible events happen, we tend to overstate or overestimate the effects that they will have on the global economy. Recent events, however, may very well be creating risks that could eclipse anything since World War II. We should not take them lightly.
I mean, that's the risk manager side of him. Right. But it's interesting. Jamie Dimon, I think, is somebody who's always been fairly optimistic about the United States and the economy. His concern about some of these geopolitical events is one that is echoed by other people who are generally pretty optimistic about things. If you talk to a Warren Buffett or someone, too.
The letter generally, I should say, is what I would describe as cautiously optimistic. Yeah, I think tonally we've just hit on what I would describe as the news pieces in the letter.
Right.
But I think tonally it's an upbeat letter. He's talking about AI. Spends a bit of time. This is 20 years now, 20-year anniversary since the bank won JP Morgan Chase deal, which actually put him in charge of the company. Talks really about the growth of the bank. It's now the largest bank by market cap in the country. Goes through a whole number of other pieces to it, management lessons and other things. It is a worthy read, by the way.
There's only a few CEOs who actually really write their own letters without worrying about lawyers and lots of other people going through and reading it and telling them what they can say, what they can't, actually writing it for them in a lot of cases. I mean, Jamie Dimon, obviously a huge one, Warren Buffett, Jeff Bezos always wrote a very straightforward letter from that you could tell was written by him with their voices. I think Larry Fink's letter this year was up there with that, where he wrote about his parents at the very top of the entire letter. That's why these letters are so interesting. And I think the tone and his tone on the markets is one that he's been kind of consistent about over the last year or so, and that is the concern about a soft landing not necessarily being as certain as the market expectations seem to be, and concern about higher inflation. Maybe we can ask Tom about that right now.
Tom's been the bull, though. Yeah. Tom's been on the other side of this, Tom. What do you think?
I think Jamie's doing his shareholders justice because they want to hear from him about all the concerns out there. I think he does a great job of detailing all the things that could go wrong. But at the end of the day, when it comes to markets, I think markets tend to price concerns very quickly. I mean, I think that's really been the concern for the last 2 years is a hard landing. And now that inflationary pressures are easing at a time when consumers don't have a lot of leverage, there's all this, there's $6 trillion of cash on the sidelines. And inflation, we don't really know how quickly it's going to.
Hold your horses for just one flip and flapjack in second. Did Tom Lee just say the consumer doesn't have much leverage? Is that what he said? Did I mishear him? Let's hear this.
I think markets tend to price concerns very quickly. I mean, I think that's really been the concern for the last 2 years is a hard landing. And now that inflationary pressures are easing at a time when consumers don't have a lot of leverage, there's all this, there's $6 trillion of cash on the.
Consumers don't have a lot of leverage? I wouldn't say that. There's a lot of things you could say, but I wouldn't say the consumer doesn't have much leverage. Like, that's just not, I don't think, no, okay. The consumer absolutely has some leverage out there. To say they don't have much leverage, I think, is a mistake.
Headlines. And inflation, we don't really know how quickly it's going to fall, but our bet at Fundstrat is that it's going to fall pretty quickly, means some of the concerns he listed about a hard landing are because of sticky inflation. And if it's softer, I think we're going to have quite a good economy.
Is this a two-pronged outlook on the economy and the markets, though, Tom? Is inflation the one big issue? And if Wednesday proves that it's a hotter than anticipated or hotter than expected CPI number, would you change your ideas about what that means for both of those things for the long term or for the year?
That's right. I think if inflation, because March is going to be the first clean CPI report. We know out of Europe, they've come in pretty soft. They've come in better than expected. If it comes in higher than expected, then I think it raises the question that the inflation is quite stubborn, and getting to that from 3 to 2 is going to be difficult. On the other hand, if it is a soft report and we think it's the probabilities favor below a 0.3, that's consensus core of 0.3, I think it's going to change a lot of people's minds that inflation may not be that stubborn.
Yeah. You have been telling people to buy, or you yourself have been buying on any dips. And by dips, we're not talking 5 or 10% drops. You're talking 2% drops, and you'd be buying into the market?
That's right. I think that there's many reasons that we still think there's gas in the tank in this rally. Part of it is that we do think the inflation trajectory is on a glide path lower than consensus expects. The second is I think there's too much caution out there. When you look at prime brokerage borrowings, or basically leverage in the market, it's still below where it was in October 2021. There's still $6 trillion of cash on the sidelines.
To push back against that leverage, not as much certainly margin in the system, especially if you compare it against the S&P 500 in general. Well, I think another huge reason that not a lot of people, almost anybody talks about, is margin. If you go back to 2021, was insanely cheap to take out, right? You get rates of 3, 4, 5%. Now go ahead and take out margin to buy stocks, and you're going to see, 8, 9, 10, 12%. So it's just, it's much riskier, obviously, to go on margin when you're talking about those sorts of interest rates. I mean, it's always risky,
with clients, right? They're still quite cautious. So as long as investors are top calling and are really looking at the world half empty, I think stocks can still rise on this wall of worry.
So Jamie Dimon doesn't surprise me at all that he has a cautious stance. He continues to have a cautious stance. It's the prudent thing to do if you're him, right? You don't want to sound, especially when unemployment's super low and you got a lot of things going on out there, you don't want to sound like, you're pumping and it's just all grand, right? In terms of Tom Lee there, right? Gas in the tank, sure, as long as we have more great numbers and great guidances, right? If we can get companies like the Metas and the Nvidias and the companies that really run this market to report great numbers and great guidance, sure, we can continue to run this market, right? A little bit, not a huge amount in terms of the overall market, but certain stocks can obviously run. If you get some of these small caps to come in and report better margins than were expected, better revenue growth than was expected, and better profit growth than expected, those ones can run as well. So we can have some fun here, right? But on the flip side, one thing that does worry me a bit is it's getting harder and harder to find bears. It just is. Even for this video, I was trying to find like bearish, videos from Bloomberg, CNBC on, why the market's going to crash or why this is going to happen or 10% pullback, whatever. It was hard to find any of that in recent days. I'll just be honest with you guys. And so that's something I'm looking at and I'm like, there's not nearly as many bears to pull over the bullish side as there was certainly a year ago or 18 months ago, right? Which kind of limits your upside at least a little bit in regards to that, right? So anyways, this is kind of my 2 cents on that particular video. Next one up here, Ed Yardeni. Let's hear what he has to say.
Investors eagerly anticipate that CPI number we're going to get later this week, a little bit of a hint or actually a big read on inflation. We want to bring in Ed Yardeni. He's the president of Yardeni Research. And Ed, I was trying to get a feel. You read so...
I wish Yardeni would get that website fixed. Like, their website used to be so awesome in all their metrics and data, and they messed it up over the past few months. And I hope they get that back together somewhat soon here, because man, they used to have it awesome.
And you have such a good sense of how markets are trending, what the psychology of markets are. You said a couple of things recently that gave me pause. Just this idea that maybe you think things have run to an extent, the farthest extent they can with the stock market for now, and that you do have some concerns about the bond market. Why don't you lay out what you're thinking, how you're feeling?
Well, I think in the near term here, we really have to focus on what's happening in the commodity markets, particularly in the oil market. The price of crude oil has jumped above $90 a barrel. It did that last week. And now this morning, it's back below $90 a barrel. But it looks as though it could very well head up to $100 a barrel if the situation in the Middle East continues to deteriorate. So I've been focusing on the geopolitical concerns, which have not been getting better. They've been getting worse. There's obviously increasing risk of direct confrontation between Israel and Iran. And if that were to happen, then the price of oil could very rapidly get up to $100 a barrel. The short-term inflationary consequences, I think, would force the Fed to basically concede that there's not going to be any rate cutting this year, and that the concerns about a wage price spiral might be back. So that's kind of where my concerns are. With regards to the market, as you said, Becky, I think we're at a 21 forward PE. I think from here on, the market goes up on earnings. And I do think that the outlook for earnings is actually pretty good. But I think this straight up move that's been based on valuation might be behind us for a little while.
It's interesting, though. Even if the Fed doesn't cut rates, as long as we don't see a huge spike in inflation,
right,
maybe companies can make up for some of these things. So you're just weighing the risks and balances, not saying that things are
That's
necessarily overvalued or that there's anything wrong here. I mean, not that there's nothing wrong, but...
Yeah. Becky, I've been kind of looking at previous decades for analogies, and I'm still thinking this will turn out to be the roaring 2020s, kind of similar to the 1920s, where we had tremendous productivity growth and tremendous prosperity. Obviously, it didn't end well, but for a good time there, it was a good time. And
that analogy, we got another 5 years left to go, Ed.
Yeah, absolutely. So there's room to grow. On a short-term basis, I'm worried about the 1970s, where we had two spikes in the price of oil, and that there was a wage price spiral that was persistent and forced the Fed to raise rates. I think there's a small chance of that happening, but it is a geopolitically related risk. And then there's the 1990s, which was irrational exuberance, which looked to be the case over the past several weeks. If you ask me to put probabilities on it, I'd say 60% likelihood that it's going to be the roaring 2020s, and then 20% each for the 1970s and the 1990s. Now, you mentioned Jamie Dimon. Jamie Dimon seems to be talking about the 1930s, so there's a lot of decades that we can look back to.
Bottom line, though, you'd tell people don't necessarily add to your holdings here, but you wouldn't sell out?
Yeah, that's correct, and I'd overweight energy. I've been recommending that for a while, and it's been a clunker, but now it's working out quite well. And I think there's going to be some profit taking here.
Okay.
So what do I think? Do I think we're going to have a roaring 2020s? Then we'll get into Tesla and inflation. And the answer to that is we're going to have a pretty good time, and we're going to have an epic crash in the 2020s, in my opinion. My opinion is we will see an epic crash at some point in the 2020s. I'm predicting exactly what year it is an impossible challenge, or exactly what month it starts, or those sorts of things. But at some point in this decade, I think we'll have a really epic crash. And if you look at how long unemployment's been, if 4% or under, I understand it's peaked up there for a little bit in 2020, right? But that didn't even really count because they backstopped everything. And then, it was a rent forbearance and mortgage forbearance and student loan forbearance and all that stuff. That didn't even count, okay? We've really had unemployment super low in reality since like 2015, 14, 16, okay? So at some point, let's just look at the history. We don't usually stay at 3 and 4% unemployment. At some point, something happens, things break in the system, and you get a massive spike in unemployment. And I think we'll have likely a big unemployment recession at some point. I just It's an impossible game to predict. Everybody tries to predict it. It's going to happen this year. It's going to happen this month. Those sorts of things. It's impossible. But I'm fairly confident it's going to happen at some point this decade. Maybe it's in a few years from now, right? Maybe it's similar to how the 2000s decade played out, right? You had obviously a big market crash. It started in 2000 and kind of finished up in 2002, kind of similar to how we had a big crash in 2020 and then another big crash in 2022, right? And then, we had the great financial crisis, which really started in 07, but it really got ugly for the stock market at 08, 09. Maybe, who knows, maybe in all of a sudden 2027, 2028, that's when it hits. I don't know. It's impossible to predict exactly when the stuff hits the fan, but I'm fairly confident at some point in this decade, we will see a pretty epic crash, okay? Just the timing's impossible. Next one up here, robo-taxi market could be substantial as Tesla nears entry.
Capital markets analyst Jairam Nathan recently cut his price target to 180 from 195, keeps him neutral. Jairam, it's great to have you. Big debate this morning about whether or not this announcement on the 8th is aspirational and kind of the way the semi was, or actually material to their next round of product.
Yeah, no, thanks for having me. I think it to a large extent depends on what they reveal. Like if it is just going to be like a shell, just as the GM's Cruise origin, might not, we won't be that enthusiastic. But the robotaxi market could be could be pretty substantial if you look at the rideshare revenues today, or gross bookings, kind of 45 billion just in the US, and delivery, restaurant delivery could be under $100 billion in the US alone. So we are talking big numbers here, and to the extent how much of that kind of market goes to Tesla by itself depends on what the model is, right? Like, would Tesla be having its own network, or will it depend on networks like Uber or Lyft? And how much of the assets are they going to be owning? So of course, like if you look at Uber's EBITDA margins, about 11-12% of revenue, it could be much higher for Tesla, given that it's autonomous, but also depend, given how much if they're owning the fleet and the network as well. Of course, if they own the fleet, capital intensity will be higher. So it's,
So this bull case narrative that AI and robo-taxis are going so well, they don't need to get in the weeds of trying to create a lower cost model than, say, BYD.
It makes sense. If you want my opinion, would I rather see Tesla sell the vehicles to Uber and Lyft and others, right? Or would I rather see Tesla actually be the Uber and Lyfts of the future, but with robotaxi? The answer is I would rather have them be the capital-intensive approach. I would much rather have them own their own fleet, because I just don't think you could compete with Tesla. I just don't think so. I think it's going to be impossible when it comes to a robotaxi fleet to compete with Tesla, because let's imagine you're in Uber or Lyft, right? Okay, now you need to buy cars from somebody that are going to compete with Tesla. Well, you're going to have to pay a margin on that, right? Like, those companies aren't going to sell you. Let's say there's somebody that can compete with Tesla and make these robo-taxis just as good of a quality and make it just as great of a product with self-driving and everything for the same price as Tesla, right? Well, the difference is that company then is going to go charge Uber or Lyft or whoever, right, a premium, because they got to make their margin. Tesla doesn't have to worry about that because they produce all their vehicles in-house. So there's no worry about, let's try to make margin on this, right? And then there's also the idea of essentially people being able to turn their current Teslas into the robotaxi fleet and be able to have those vehicles out driving people around at a given time. So let's say, like, I'm not using my car, 2 a.m. to 8 a.m. So I'm going to have my car go drive people around, and have it get down to 25% energy. Okay, boom, your car can do that, and then it comes back home, is ready for you to take it in the morning, you charge it up while you're at work or whatever. There's so many possibilities when it comes to that. So, the possibilities are really endless. So Tesla's just insanely well positioned for that, but it's not like this is happening tomorrow. It's not like tomorrow you're just going to see robo-taxis everywhere and Tesla's making all this money from that. It's going to be over a long period of time, and they'll get more and more popular and more more popular. And, no different than Uber. It wasn't like everybody just woke up and started taking Ubers one day. It was like Uber's been growing as a company for a long time now at this point in time. And now it's like this huge, big household name.
Is that something you're willing to bet on?
Yeah, so, I think the Model 2 or the lower cost model is, I don't think has a huge impact in the US, given that segment. If you look at the small cars, small CUV, it's about 18% of the market. But I think it is very important outside the US. But at the same time,
this is another thing that, you want to know why Tesla's doing Tesla Insurance, and, they're building out all these other businesses, right? The supercharger fleet. The other reason is, think about this logically, right? Why, if let's say you're Uber or Lyft or whoever, and you got somebody insuring this fleet of robo-taxis, now they're going to make a margin on that, right? 10, 20%, whatever. They're not going to sell you that car insurance for whatever it costs. No, they want to make a profit. Tesla, since they're going to have their own insurance in-house, and that's going to be built out likely over this next 5-10 years, probably in a substantial way, right? As that builds out, Tesla's going to be able to insure their own robo-taxi fleet. And then if there's ever a problem, they're going to be the ones that can take the brunt of that. But at the end of the day, they don't have to pay that margin that, somebody else would have to pay. So when you look at all this stuff that Tesla's doing in-house, also, if you want to charge all the vehicles, where are you going to charge all those vehicles out? Probably Tesla superchargers, right? Tesla's going to make a margin on that for all the other robo-taxis charging at likely Tesla's chargers. And if you don't do that, then you got to build out your own supercharger fleet. I mean, we've seen how that's worked out. That's why all the big auto companies are all partnering with Tesla now. So that's like, yeah.
The competitive intensity is much higher, especially with companies like BYD, and are extremely cost competitive. Especially, I think you need to have a good LFP sourcing, battery sourcing, and China is much ahead of the rest of the world in that regard.
All right, next one up here, inflation outlook.
New York Fed. For that, we'll turn to Steve Leisman. Hey, Steve.
Carl, good morning. Much anticipated inflation expectations numbers from the New York Fed, and they are mixed for the month of March. I'll go through them now. The one-year inflation expectations were unchanged at 3%. It's good news amid higher oil prices and other commodities. They're unchanged, but they have been stuck at this 3 number for 2 months running now. Not sure how much concern there'll be on the part of the Fed. The 3-year expectations up 0.2 to 2.9%, while the 5-year declined to 2.6. I think last month was an aberration at 2.9. It's now down more near its long-run average. However, before you get too excited about that, the New York Fed saying expected price changes increased for all goods in the survey, and there are some hefty ones. For example, rent went up by 2.6 percentage points to 8.7. Remember, we're looking for that to come down. Medical care up more than a percentage point. Food up and gas up as well. Interesting. These are separate questions. They ask about overall one-year expectations, then they ask about individual prices over the next year. Unemployment expectations remained low in this. That's good news. But concern about job loss rose to the highest level since October 2020. It is up for a second straight month and now above the pre-pandemic level. That is concern about job loss. The probability of missing a debt payment, we've been watching that pretty closely. The issue of delinquencies rising to the highest level in 4 years. All of this happening in context of lessening certainty about a rate cut. We're now, dancing around that 50% line. We're at 51% now for June. We had been below 50 this morning. It's down from 65% before that strong Friday jobs report.
Keep bringing it down.
July, I'd say, is also a little bit in play here, now at 69%, down from 80%, Carl. So a lot of things in motion now. The Fed watching this inflation expectations number to get a gauge on whether they're winning the battle of the psychology of inflation, and they seem kind of stuck at this 3% level.
So that's, a little bearish, right? That's the problem with this dang inflation. We haven't slayed the dragon yet. Like we had the dragon kind of down and but we haven't put the finishing move on this beast yet. And if you have housing start to come back, there's some rumblings about housing prices potentially going higher for the remainder of this year, right? Rents going higher. housing inflation's been a problem. If that's going to come back and be a bigger problem when commodities are running, right? And let's say oil runs into the summer, cause inflation to be stickier. And then if you still have services inflation, wage inflation, you got still wage price spiral going on there, right? It's just like the dragon hasn't been slayed yet. And that's a problem because we can't give up the fight. The Fed can't give up the fight, I should say, against inflation until it's donezo, until it's finished. And so, I mean, it is what it is. It's what we have to deal with. It's the situation at hand, okay? Appreciate you guys joining me as always. Thanks so much for being here. Once again, make sure you get that pinned comment down there, into your info, and we'll send over that deal as soon as it drops. April 15th, it is a 24-hour sale only. And next time we do a sale in there probably won't be for, I don't know, maybe till like Black Friday or something like that, maybe in November. So yeah, that's your big chance. Pin comment. Much love and have a great day.